studying your last two. I swim with tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
Up to this point, we've spent a lot of time discussing timing differences, estimates, T-slips, and fiscal years. Now it's time to step back and look at the bigger picture. One of the most important concepts in investment income reporting is understanding how investment income actually behaves over time. Many new tax preparers think of investment income as a series of separate annual events. They look at one taxation year, one T3 slip, or one T5 slip and assume each year stands alone. But in reality, investment income does not work that way. Investment income is a continuous flow. Think of it like a stream of water moving through a pipe. Every day, investments generate interest, dividends, capital gains, and other forms of income. That income continues to accumulate whether or not a reporting period happens to end. The corporation may have a fiscal year ending on February 28th. The investment institutions may report on a calendar year ending December 31st. But the underlying income never stops flowing. This is exactly what the timeline in the slide is illustrating. As we move from year 1 to year 2, and then to year 3, investment income continues to enter the corporation. At the same time, T3 slips, T5 slips, and other tax reporting documents continue to capture portions of that income and report it over time. The key observation is that the flow never stops. The reporting periods may change, the timing may shift, but the income itself continues moving through the system. This idea is especially important when dealing with non-calendar year fiscal periods. Students often become concerned when they notice that a particular amount of income does not appear in the current year's reporting. Their immediate reaction is to ask, "Did we miss that income? Did it disappear?" The answer is almost always no. In most situations, the income has simply moved forward in the reporting process. It may appear on a future T3 slip. It may be reported in a later taxation year, but it has not vanished. That is why experienced accountants often think differently than new students. Instead of focusing only on one taxation year, they look at the movement of income across multiple years. They understand that investment income behaves more like a flowing stream than a collection of separate buckets. And once you adopt that perspective, many of the timing differences we've discussed throughout this chapter become much easier to understand. The key takeaway from this slide is simple. Investment income is a continuous flow. T-slips capture portions of that flow. Corporate tax returns report portions of that flow. And when timing differences occur, the income usually moves forward through the system rather than disappearing. Understanding that concept is the foundation of effective reconciliation and one of the most important lessons in this entire topic. Now that we understand that investment income flows continuously through time, let's talk about one of the most important tools accountants use to track that flow: reconciliation. The word reconciliation can sound intimidating, but the concept is actually very simple. Reconciliation is the process of explaining differences between two sets of numbers. And when it comes to investment income, those differences are often caused by timing rather than mistakes. Let's start with the way many students initially view a reconciliation. Suppose they compare the income shown on a T3 slip with the income recorded in the corporation's books. The numbers don't match. Immediately, concern sets in. They begin asking questions such as, "Did we miss some income? Did we record something incorrectly? Is there an error somewhere?" While mistakes can happen, experienced accountants approach the situation differently. Their first question is usually not, "What's wrong?" Their first question is, "Can this difference be explained by timing?" That shift in thinking is extremely important. As shown in the center of the slide, investment income moves through several stages. It begins with the investment institution. The institution tracks interest, dividends, capital gains, and other forms of income throughout the year. That information is then summarized on tax reporting slips, such as T3s and T5s. The corporation records the information in its accounting records. The amounts eventually flow into the corporate tax return, and ultimately, the information is reported to CRA. At every step, timing differences can arise. The reporting periods may not align perfectly. The corporation may have a non-calendar year end. Certain amounts may appear on one T-slip, but not yet be reflected in the books. Or income may be reported in a different taxation year because of the methodology being used. This is exactly why reconciliation is so valuable. It helps us understand where those differences came from. Let's look at the example shown on the slide. Suppose a T3 reports $10,000 of income, but the corporation's books show only $9,200. There's an $800 difference. A new student might immediately think something is missing, but an experienced accountant asks a different question. Where did that $800 go? Did it move to another reporting period? Will it appear in a future tax year? Was it already reported previously? In many cases, the answer is yes. The difference is often the result of timing rather than omission. This is why reconciliation is not really a search for missing income. It is a process of tracing income through the reporting system. The objective is to explain every difference and demonstrate that the income has been accounted for somewhere within the overall flow. A good reconciliation tells a story. It explains how income moved from investment statements to T-slips, to accounting records, to tax returns. And when that story is complete, the accountant gains confidence that all income has been properly reported. The key takeaway from this slide is simple. Reconciliation is not about finding missing income. Reconciliation is about understanding timing differences and explaining where the income moved. And once every difference can be explained, the reconciliation has done its job. Throughout this chapter, we've discussed non-calendar year ends, T-slips, estimates, reconciliations, and the challenges of matching investment income to a corporation's fiscal year. Now let's step back and look at the bigger picture. When students first encounter these timing differences, they often become concerned. They notice that a particular amount of income was not reported in the current year, or they see that the amounts on the T3 slip do not perfectly match the amounts in the corporation's books. Their immediate reaction is often, "We made a mistake. Some income is missing. Something must be wrong." And that's a perfectly natural reaction. But experienced tax professionals usually see the situation differently. Instead of immediately assuming that income has been omitted, they ask a different question. Has the income actually disappeared, or has it simply moved to another reporting period? That question is at the heart of professional reconciliation. As shown in the timeline on this slide, investment income continues to flow year after year. The corporation earns income continuously. T-slips are issued continuously. Tax returns are filed continuously. And as the years pass, that income keeps moving through the reporting system. A particular amount may not appear in one taxation year, but it may appear in the next T3 slip, or it may have already been reported in a previous year. The key point is that investment income usually does not vanish. It flows, it moves, and it eventually reaches the tax reporting system. This is why experienced accountants are often comfortable using methodologies that create timing differences. They understand that timing differences are not necessarily reporting failures. As long as the income can be tracked, explained, and ultimately reported, The reconciliation process is working. Notice the contrast shown on the slide. The student sees an income difference and immediately worries that a mistake has occurred. The experienced professional sees the same difference and asks for a reconciliation. They want to understand the movement of the income before drawing conclusions. That mindset is one of the most important skills in tax and accounting. Good accountants do not panic when numbers differ. They investigate, they reconcile, and they determine whether the difference is truly an error or simply a timing issue. This perspective provides several benefits. It improves understanding of T-slips. It improves understanding of fiscal year timing differences. It strengthens professional judgment, and it helps accountants make better reporting decisions with greater confidence. At the center of all of this is a simple rule. Whenever you encounter a reconciliation difference, ask yourself, is the income actually missing? Or has it simply moved to another reporting period? In many cases, that single question will lead you directly to the answer. The key takeaway from this slide, and from this entire section, is simple. Most reconciliation differences are timing differences, not missing income. The goal of reconciliation is to understand the flow of income through time, explain every difference, and ensure that all investment income is ultimately reported correctly. Once you understand that flow, investment income reporting becomes far less mysterious and much easier to manage.